What is going on, YouTube Nation? This is Start Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I really thought about this. I really have a goal to make $1,000 to $3,000 a month on monthly dividends and $2,000 to $4,000 a month on my quarterly dividends. So when it comes to reliability, QYLD is not reliable, RYLD and XYLD. That's one thing I have a problem with these guys. And there's QYLG and XYLG. I had a discussion with Matt Money regarding that. And they are better. I mean, you're going to get growth. You're going to get price per share probably increase. And you're going to get, if you want to call it passive income, because some people claim it's not dividend income because it's covered calls. So you look at those ones with hikes. And I like dividend stocks with hikes. And in my previous videos, I discussed stocks that I had that were turnoffs. Now, again, my investing strategy evolves and changes. And I've been very turned off by QYLD, RYLD, and XYLD and DJIA. But, again, in the long run, I will be buying those guys for good income. But remember, I went over the box theory, and I'll post that video at the end if you guys are new to this YouTube channel, on why I don't like QYLD or RYLD and XYLD with my box theory that I have, because you're stuck in a box. And I explained to you in my video at the end regarding that. So these REITs do have increases. Some of them I'm a little bit turned off on, but I'm probably going to bite the bullet because I have a lot more resources now with making money and being a travel nurse. So obviously being very frugal, and I've been very frugal. I've just been throwing money into my portfolio. I mean, I just threw $1,000 into ARK today. So I have ideas that I can do. And, I'm highly likely going to pull the trigger and make changes to my dividend portfolio and add these REITs. Again, before I was turned off. But sometimes you just have to bite the bullet and have a diversified portfolio, which I do, and I love REITs. I love real estate investment trusts. Remember, 90% of what they make come back to us as investors. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos as I review these REITs that I'm probably going to buy. Now, again, this is not financial advice, for entertainment purposes only. Disclaimer in the description. Smash that like button. Let's check these REITs out right now. So the first dividend stock that I went over in my previous video the past few days, I'll put it in the top right-hand corner, which are some turnoffs, is Stag Industrial. It's sitting at $31.50. The dividend yield is 4.63%. The PE ratio is 23.75. The average volume is 1.66 million. Market cap is $5.62 billion US dollars. Year range is 2656 to 4827. Its day range is 3150 to 3157. And its previous close is 3134. So recently I did sell Stag and threw it into EPR Properties. This was not done in vain because I posted in my video why I like EPR. So I kind of capitalized on those guys. And I'm probably not going to buy any more shares of EPR. I'm just going to reinvest their dividends, which I feel very confident about with those guys. And I'm going to put that in the top right-hand corner after this section of why I sold Stag and put it in EPR. But Stag is still an attractive strategy for my monthly dividend strategy. So I'm going to go over these guys briefly. So Stag Industrial is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. So they have 563 buildings. The number of states is 41. Square feet is 111.6 million. Its enterprise value is 7.7 billion, and its symbol is Stag. So one thing I just want to go over. So my investing strategy changes all the time. This is why I post videos, because I tell you what turns me off, my thoughts, my strategies. Again, don't take everything for heart, because I'm not giving financial advice. This is all for entertainment, but so far things are paying off for me very well, and I have a lot of resources. now to make a lot of strategies. So I'll go over their revenue and their dividend history. So revenue-wise, they're doing pretty well as a specialized real estate investment trust, which is an industrial REIT. 2015, it was 218, 2016, 250, 2017, 301, 2018, 350, 2019, 405, 2020, 483, and 2021, 562. So if I pull the trigger on these guys, I will do a detailed video on these guys on why I rebought them. But remember, at the time, I thought it was good to sell them and put them in EPR properties. I have a lot of shares in EPR properties, and I'm very happy with that decision I made. So now let's go to the dividend history. So let's start with their dividend history. There are a lot of cons and there are pros to it. So the pros are their revenue is increasing. The cons are the dividend growth is atrocious. So starting in 2014, it was 11 cents. 2015, it was 12 cents. 2016, it stuck at 12. 2017, it stuck at 12. 2018, it stuck at 12. 2019, it stuck at 12. 2020, it stuck at 12. And then 2021, it was stuck at 12. And it's still 12 cents. So you have terrible, slow dividend growth. The payout ratio is 67%. The dividend growth in 5 years is 0.70%. It is atrocious. But again, STAG is way better than investing in a bond. So if you bought one share, you made 146 with a 4.66% dividend yield. Number of dividend increases the last 5 years is 6. That hurts. And I'm going to tell you, Prologis is way better as an industrial REIT. I'm just going to tell you that right now. That's one that I am going to probably try to squeeze in my M1 Finance dividend portfolio. I need to get to a lot of shares and a lot of stocks before I do that. But Prologis runs circles around STAG. I'm just going to tell you that right now. There's no way STAG can keep up with Prologis. So I'm just going to tell you right now, if you say what's the difference between STAG and Prologis, STAG is like the Rutgers in the Big Ten Conference in football, and Prologis is like the Ohio State in Big Ten football. So they just run circles around them. So before you even mention anything, or if you're watching this, there's no comparison. So let's jump to the next dividend stock. And here's another one that I have, Gladstone Land Corporation. These guys have beat the S&P in the past 5 years, and they're still neck and neck with the S&P. They have a dividend yield of 2.80%. The average volume is 210.25K. The market cap is $671.20 million US dollars. Its year range was 1728 to 4210. Huge dip. Day range was 1960 to 1976, and its previous close was 1953. So these guys do have a very slow dividend growth. I like an aggressive dividend growth, but the problem is, it's just once I go over the dividend growth, it is a turnoff. But in the long run, there is a lot of potential with these guys. And again, with a real estate investment trust, being diverse is very important. And with land, I'm going to go over these guys real quick because they are still an attractive dividend stock, especially a monthly dividend stock. They offer long-term sale leaseback transactions, which allow them to free up capital and improve their farming operations. They purchase the farms and then rent them to farmers with flexible lease terms. They offer cash purchase of the land while keeping the existing tenant farmers in place and finding new farmers as needed. So I'm going to go over their portfolio real quick. So right now, they have been getting bigger. Every time I go to their website, I see news about acquisitions. So again, it's long-term investing. This is what you're about. 90% of what they make go back to investors. Farmland is starting to get huge. People are trying to invest in farmland and for money. So people are discussing this in the news about, owning sections of farmland. So this is something that's huge. And people need food. And I'll give you an example just by clicking one state why these guys are the real deal. One example in Georgia, where they have 230 gross acres with 175 planted acres of blueberry bushes in Georgia's Atkinson County. So these are just blueberries. And the water is 3 irrigation wells and surface water. They were acquired in 11/12/2021. So these acquisitions are starting to get new. These guys are, I would consider, a new kid on the block. And I will go over their revenue and dividend history. So in 2015, this is in millions US dollars, it was 11.9, 2016 17.3, 2017 25, 2018 36, 2019 40, 2020 57, and 2021 75. So again, 90% of what they make go back to investors. So they are starting to acquire companies like crazy. So it's one of those things, bite the bullet, get to 100 shares, leave it alone, and see what happens. So 10, 15, 20 years, flip it, and then take the passive income. That's one thing I can do, and just leave it alone, never touch it again, and go from there. So let's check out their dividend history. So this is extremely slow. So let's start in 2014, it was 3 cents, then 2015, 4 cents, still stuck at 4 cents, to 5 cents in 2019. And then hopefully it'll hit 6 cents eventually, but it's at 22 cents. And in the long run, remember, QYLD, RYLD, and XYLD, you're stuck. And the payout ratio is 80%. The number of dividend increases in the last 5 years says 20, but it goes so slow with their dividend growth. 5 years at 0.62%. So if you bought 1 share, you made 55 cents with a 2.81% dividend yield. So long run, 100 shares, reinvest the dividends, go from there. So that's one thing that I'm looking at. Let's jump to the next dividend stock. This is one that took a hit. So what I did in M1 Finance is I sold these guys, and I'm going to be probably throwing them in E-Trade. They have a dividend yield of 5.92%. These guys, I'll go in detail with them. They have a PE ratio of 16.38, average volume 230.39K, market cap 1.56 billion US dollars. Year range is 31.36 to 45.49. Its day range was 38.28 to 38.51, and its previous close was 38.11. So these guys are down. They haven't kept up with the S&P, which makes them attractive, and I will go over these guys as a company. So LTC is a real estate investment trust that invests in senior housing, healthcare, primarily through sale, leaseback, mortgage financing, joint ventures, and construction financing. I like this part right here. The other thing is the portfolio is comprised of approximately 50% senior housing and 50% skilled nursing facilities. So I'm going to go over their portfolio. They have 125 assisted living facilities, 78 skilled nursing, and 210 properties. Now, since they are somewhat diversified, I'm going to go over their revenue and dividend history. Now, there is one red flag you need to be careful with. So let's go over the revenue. 2015, this is in millions US dollars, 136, 2016, 161, 2017, 168, 2018, 168, 2019, 185, 2020, 159, then 2021, 155. So 2020 to 2021, there was a decrease in revenue, but there was an increase in revenue from 2015 to 2021. So let's go over a few things in detail. So look at this in December. There was a decrease in revenue, 39.44 million, and net income dropped. Net profit margin went down. Then March, there was an increase. So the revenue went up 41.16 million year to year. Well, I'm sorry, it was at 41.16 million. Year to year, it went up. Net income went up 4.72% to 14.41 million. Net profit margin went up 3.21%. Operating income and net change in cash, be careful. June revenue went up, net income went up, diluted EPS went up, net profit margin went way up, 129.17%. So it's went up 169.95%. Operating income went up, net change in cash went up. So the other thing is the revenue went up year to year, 43.5. Net income went up, diluted EPS went up, net profit margin went up 30.55%. Operating income went up 22.63. So what I still like about these guys is, think about this. When people get sick, they have to go to skilled rehab facilities. Now there's a rise in diabetes, there's a rise in heart attacks, there's a rise in obesity. And when people get sick or get amputations from being in the hospital, being diabetics, guess where they have to go? To facilities. So that's one thing that you have to be aware of. And this is why I am still attracted to these guys. And in the long run, I'm highly going to buy these. I'm going to be buying them. I just need to probably pull the trigger on a few stocks first, monthly dividend stocks, because these guys haven't done well against the S&P, but land is way down. So that's one thing that I may capitalize on, and Stag Industrial. So again, I have a monthly dividend strategy. If I get to 100 shares and just reinvest the dividends and leave these guys alone, there's some serious potential there. So that's why I'm just saying and posting this video that, QYLD, they're out for right now, and I need to start adapting. So let's go over their dividend history. And again, the dividend growth is a little bit slow, but we have to think long term. So 2014, 17 cents. 2015, 18 cents. 2016, 19 cents. Still stuck at 19 cents. Still stuck at 19 cents. And then 2021, it's still stuck at 19 cents. So the dividend growth in 5 years is not the best. The payout ratio is 95%. If you bought one share, you made $228 with a 5.98% dividend yield. Now, this is probably going to be one of the last stocks that I buy with my strategy if I do this, because, Stag's down and land is down. So that's one thing that I have to consider, is there is a significant dip and these guys are growing. There's a little bit of red flags, again, because people are worried about this, and because of the pandemic, again, people didn't want to go to rehab as much. So the numbers are starting to come up. The admissions, it appears, are starting to go up. You can correct me if I'm wrong, but this is diversification is important. We got farmland, we got LTC Properties, we got Stag, and I got two more for you. Here's a dividend stock that you have to be a little careful with. So I'm treading water carefully with these guys. SL Green Realty Corp. Dividend yield 9.80%. That's high. Average volume 1.20 million. The market cap is 2.49 billion US dollars. Year range is 35.77 to 85.15. Major dip during the pandemic. Day range is 37.85 to 38.59. Its previous close was 37.42. So where are these guys and where are they located? They're New York City's largest owner of office real estate. So let's go over some of their properties. So they have 1 Vanderbilt Avenue. They have a building. They have 1 Madison Avenue. They have 10 East 53rd Street, 100 Church Street, 100 Park Avenue, 11 Madison Avenue, 10 Green Street, 1185 Avenue of Americas, 125 Park Avenue, 1350 Avenue of Americas, 1515 Broadway, 185 Broadway, 2 Herald Square, 215 Park Avenue, and 220 East 42nd Street, and others. So one thing that is an issue with New York is crime and violence and increase in tax rates. So many people are moving out of New York. I can tell you, I would never live in New York. The price, there's an increase in violence, and it is a mess. So that's one thing that you have to take in consideration. Now, people love to live in New York because of the name and it's New York and blah, blah, blah. But I wouldn't want to pay all those taxes. These guys are a business. They know what they're doing, okay, as a real estate investment trust. I'll go over their revenue and their dividend history real quick. So this is one that I'm seeing trends in that I need to be careful with. So 2015, it was 1,662. This is millions US dollars. 2016, 1,863. 2017, 1,511. 2018, 1,227. 2019, 1,238. 2020, 1,052. And 2021, 843. So as I explain things, people jumping ship and leaving, that's going to be a problem for these guys. So this is one that I'm keeping a very close eye on. I actually bought their shares and I'm highly considering selling these shares. So this is one that totem pole wise is way on the bottom for me right now. So I'm going to go over their dividend history. So one thing you have to be aware with monthly dividend stocks and quarterly dividend stocks is when they convert quarterly to monthly, because that can signal a yield trap or problems in the long run. So already you saw a decrease in price per share with these guys, which becomes a problem. And that kind of reminds me of AGNC. 2015, they were 60 cents. Then 2016, they jumped to 72. 2017, they jumped to 78 cents. 28 cents, they jumped to 81 cents. 2019, they jumped to 85 cents. Then 2020, they jumped to 89. Then in 2020, then they said we're going to be a monthly dividend stock. So 30 cents. Right here, you got a little special dividend at 68 cents, but they're at 30 cents. And then you got a little special dividend at 275, and then they're 31 cents. So the payout ratio right now, according to Zacks, is 56%. The number of dividend increases in the last 5 years is 5. Dividend growth in 5 years is 2.08%. Annual dividend, if you bought one share, you made $3.73 with a 9.97% dividend yield. Now, the problem is these guys are just in New York. Now, people want to live in New York. That's just the name. But there's a lot of people moving out of it and a lot of businesses moving out of New York because, my gosh, I mean, the stories people tell me of living in a studio and everything and how much they have to pay rent. So just imagine the office spaces over there. So you better have a lot of money being over there and, bite the bullet paying taxes, because I wouldn't want to live in New York. I wouldn't want to live in California because of the taxes. Now let's jump to the final dividend stock. And here's my competitor to Realty Income, Green Realty Corporation. I think these guys are a competitor to Realty Income. They're right now 68.50, a dividend yield of 4.21%, a PE ratio of 38.47, average volume 867.63K, market cap 5.47 billion US dollars. Its year range was 61.62 to 80.44. Its day range was 67.82 to 68.40, and its previous close was 67.81. Now, if I want to get to 100 shares of these guys, I may consider getting them on M1 Finance and having my dividend stocks buy them. Because, my gosh, once I start getting dividends from other dividend stocks, there's a capability of having these guys get bought from stocks like ARC with the dividends from AFCG Gamma. This is why I considered putting QYLD, RYLD, and XYLD in my M1 Finance, and I still may do it because I can buy stocks like this. And I love these guys. Check this out. So they have 1,707 properties, 36 million square feet, 68% of investment grade. And look at their properties that they are a major landlord to. Aaron's Rents, Academy Sports, Advanced Auto Parts. So you're looking at recession-proof and pandemic-proof places. Let's keep on going. Advanced Auto Parts. There's a lot of them. People need cars fixed. Aldi's is very popular. So Amazon Fresh, AMC, they're a landlord to AMC, Applebee's, Arco, Ashley Furniture, Aspen Dental. Remember, people need their teeth cleaned. AT&T is still in business. So AutoZone, I like that one. I mean, there's a lot of AutoZone facilities that they are a landlord to. I mean, I'm just scrolling down, which is impressive. I mean, I'm still going in A. This is Bank of America, Barnes & Noble, Bass Pro Shops, Bed Bath & Beyond, Bell Tire, so Best Buy, they're a landlord too. Let's keep on going. Dollar General, they are a landlord to Dollar General. So it kind of reminds you of the portfolio of Realty Income. There's Family Dollar, Fresenius Medical Care. Fresenius is in demand, let me tell you, because Warren Buffett invested in Fresenius, but that is a dialysis center. And guess what? People are getting sicker. There's a higher demand for dialysis, and they know what the heck they're doing. So let's do a few more. I just want to show you NTB, O'Reilly's Auto Parts, Sherwin-Williams. People still need to paint houses. There's a Sonic. So Spirit Halloween, Sunoco, they're a landlord to Taco Bell. These are all busy places. Target, Texas Roadhouse, TGI Fridays. So I just went over a brief thing. Thornton's, I mean, gosh, I'm still going. Tire Kingdom, Tires Plus. By the way, I need new tires soon. TJ Maxx, Tractor Supply, Wawa, which is a kind of new, little trendy. Wendy's, they're a landlord to Wendy's. So you're seeing all these things and a lot of 7-Elevens. So these guys are well diversified. Now let's go over their revenue and dividend history. Now you want to talk about guts. These guys are a quarterly dividend stock that put themselves on the map as a monthly dividend stock. So 2014, they were 43 cents, 2015, 45, 2016, 47, then 48 cents, then 50 cents, and then 2019, 56 cents, then 2020, 59 cents, to 60 cents, to 62 cents, then all of a sudden 21 cents. They became a monthly dividend stock in 2021. Then to 22 cents, then to 23 cents, then to 24 cents. So they just cracked the 24-cent mark. So the dividend growth in 5 years is 6.72%. If you bought one share, you made $288 with a 4.25% dividend yield, and the payout ratio is 75%. So my monthly dividend strategy is going to consist of these dividend stocks. SLG is probably at the bottom. I'm not going to touch those guys right now. But dollar cost averaging, Green Realty Corporation is going to be one that is high in regard and probably number one, and go from there. So again, if you watch my future videos and if you subscribe to my channel and hit the notification bell after you check this out in this video, this is a strong possibility of getting to my goal of $1,000 a month in monthly dividends and $2,000 to $4,000 a month my quarterly dividends. But this 1,000 is what I like and what I'm gunning for. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. You guys take care and have a good one, and I will reveal to you my dividend income tomorrow. Take care.